Morning, Top Gun here, 5 a.m. on the West Coast, Tuesday, April 27th. This is the YouTube pre-market commentary. All right, section 1, boom or bubble. So there's a debate raging in financial markets about if what we've seen in financial markets since the March 2020 COVID lows represents the beginning of a massive economic boom, a la the Roaring 20s or the early 80s, or it represents a massive bubble. So I've excerpted two Wall Street Journal articles from yesterday, each sort of arguing for one side or the other. So in Justin Lehart's piece, he talks about how economists on average are forecasting real GDP growth of 6.7% in the fourth quarter of this year. It's just huge real GDP growth. And that's the consensus that's being priced into markets, in financial markets. Obviously, everything is up. It is pricing in a massive economic boom. Now, is that real? Now, Jeremy Grantham takes the other perspective and says, no, this is a massive bubble, and it's a very unique bubble. And I think that's best supported by the evidence. So if you take a look at the charts in these two tweets by Holger Zapitz, you can see the balance sheets from the Fed and the ECB. And the Fed's balance sheet has expanded about $3.5 trillion since COVID, and the ECB's 3 trillion euros. The Fed, obviously, $3.5 trillion. And all that money has flowed into financial markets. Now, obviously, that's going to push prices up massively, and that's what it's done, and it's created a disconnect between financial markets and economic reality. Now, the best framework for thinking about this is Austrian economics. And unfortunately, very few on Wall Street, if any, are familiar with Austrian economics. The best proponent of Austrian economics was the economist Ludwig von Mises, who started exploring the issues of money and economics in the theory of money and credit in 1912, and most famously in Human Action in 1949. And the idea is really simple. It's that when the central bank creates money out of thin air and puts that into the economy, it creates an artificial boom. So prices go up, it creates this illusion of prosperity, but it's just an illusion. And ultimately it causes inflation, and that inflation ends up ruining the economic boom, because either the central bank tightens or it lets inflation get out of control, and inflation is absolutely insidious for an economy. As I've been writing about, inflation is actually already here. It's seeping out of financial markets into the real economy in the form of commodity prices. And that was shown, I talked about that last week in terms of Procter & Gamble and Kimberly-Clark are going to be raising prices on their consumer products. It's just one example, but those are two big companies that all of us buy, Crest, Tide, Huggies diapers, toilet paper, those types of things. Prices are going up, that's inflation. I use a quote from Henry Hazlitt: "The art of economics consists in looking not merely at the immediate, but at the longer effects of any act or policy." And so what you're seeing in the short term is this huge sugar high, and it looks like an economic boom, but it's just a mirage. And what's going to happen is inflation is going to ravage everything and destroy this economy and the financial markets as well. Okay, moving on. If we're going to talk bubbles, we got to talk Tesla. So Tesla reported earnings yesterday afternoon, and what's interesting about Tesla is that the quality of their earnings have been questioned for a long time, because they make a lot of their money from selling automotive regulatory credits to companies that that produce fossil emissions, cars that produce fossil fuels emissions. Tesla gets these credits for producing these electric cars, and they sell those to the other automakers. And so for a long time, the quality of their earnings has been questioned, because so much of it comes from the sale of these regulatory credits. And now in this quarter, it turns out that Tesla made $101 million from its speculations in Bitcoin. So if you subtract the $518 million that they made this quarter from selling automotive regulatory credits, and the $101 million from Bitcoin speculation, from their $1 billion and $67 million non-GAAP net income, you get non-GAAP net income of $448 million, or 40 cents a share, versus the 93 cents per share they reported. Neither is significant, but 40 cents for a stock that closed yesterday at $738.20 is really a pittance.